The pace of Canadian inflation is heating up, with core CPI hitting 2.4% in September. But will it be enough to give the Bank of Canada pause at next week's rate decision? Joining us now to discuss is Robert Both, Senior Macro Strategist with TD Securities. And Robert, thanks very much for joining us. I'm glad that you were able to make it in after that big Blue Jay victory last night.
It's my pleasure, Anthony. Fantastic to see the Jays back in the World Series, and I'm sure in a couple months we'll be talking about ticket price inflation exactly. In a whole new way as well.
Exactly. Okay, well, let's talk about the headline numbers. What's your reaction to the latest inflation news?
So inflation's certainly heating up. Now, we were looking for inflation to accelerate in September. Our forecast was for a move from 1.9% to 2.3%. We weren't too concerned about that acceleration, largely because a lot of that was driven by energy prices. Gasoline prices did rise in September. They typically come off a little bit in the fall, and that return to, or that move away from summer driving season. So that did contribute to a bit of the year-over-year acceleration. But what we saw was a little bit more broad-based headline inflation surprise to the upside, coming in at 2.4. Prices rose by 0.1% month over month. And there were a couple other key drivers in addition to that energy component. One was the price of food. Food prices were up 0.4% month over month, even with a bit of a seasonal headwind. Around harvest time, you tend to see lower prices for fresh produce. That wasn't enough to keep a lid on food prices in September. You also saw a little more strength come through those travel components. And when you put all of that together, the core inflation measures that are referred to as the bank's preferred measures, CPI trim and CPI median, they have been sitting around 3% for the last 5 months or so. Those actually ticked a bit higher to 3.15% on average. But not every core measure was quite as firm. Others, like the CPI-X, ex-food and energy, they're painting a somewhat softer backdrop for core inflation pressure. So the Bank of Canada has got a lot of information on its hands for their decision next week. But we think key to that decision will just be that those 3-month rates of core inflation, which the bank has put a little bit more weight on in the recent communications, those didn't see as much change. Those aren't pointing to any acceleration here. So for that reason, we think that the Bank of Canada can look through a lot of the strength in this report. Okay,
so and as you dug into this report, does this look like it's a one-off, or are we in a period of rising inflation?
So we are treating this as more of a one-off. Food, energy prices, these things tend to be a little more volatile. Monetary policy works with a lag. So if the Bank of Canada were to put a lot of weight on those in their policy decisions, well, prices might have self-corrected by the time that, the impact of that policy path really shows itself. So you also saw another large increase in rents. Those can be a little bit volatile as well, and travel services. So we do think that this is unlikely to be sustained. If you look at just kind of core goods inflation, so strip out food, energy, strip out services, shelter costs, those prices are still rising by about 1.6%. Largely, they've been actually a little bit softer than they were a few months ago. So, we're still not seeing large tariff impacts in Canada. This isn't a tariff story. Especially with some of the volatility in the Canadian dollar as well, putting a little more upward pressure on food prices. We think that the Bank of Canada will look through this one and can still deliver another 25 basis point rate cut next week.
And that was my question. How does that set it up? But it looks like you're still looking for another cut from the Bank of Canada next week.
Well, it does raise the stakes for the Bank of Canada. Their last move in September brought policy from a neutral stance into slightly accommodative territory. Another rate cut would take them further into accommodative territory. And if these aren't one-off pressures in inflation, if there is a more durable driver behind this move, then those rate cuts could be pouring a little more fuel on the fire. So we think that the Bank of Canada can look through this. We think that those factors that drove the upside surprise in September are unlikely to sustain themselves going forward. But the Bank of Canada has said that it's going to be a little bit less forward-looking. So, they're forward-looking. They see an economy that's where growth is quite weak. We're seeing more excess supply. That's putting downward pressure on inflation. But if they don't have as much conviction in their forecasts in the headwinds that excess supply is going to put on inflation, that could give them a little bit of pause. We think they'll come down on the side of a rate cut, but the market has walked back their expectations of a cut after CPI.
Now, do you expect them to return to the sidelines if we do get a cut next month, or is there a potential for them to cut again?
Well, the potential is always there. The option is there if they need it, but we do think that the next cut will be the last one of their cycle. That would bring them 50 basis points below that estimate of neutral. We think that is going to be enough stimulus to provide a little support to GDP growth into 2026. And we also think that, as we get further into the next few weeks, we are going to see another federal budget as well. We do expect to see a little more fiscal stimulus coming through that budget. So that's going to provide another driver for GDP growth over the next 2 or 3 years. And we think with that level of support coming from the government, the Bank of Canada will be in a better position to move back to the sidelines into December and beyond.